Hello everyone, myself Dr. Ibha Rani. In this session, I will be discussing about mastering debits and credits, the foundation of accounting. And my table of content, the agenda of this video will be the introduction of debit and credit and how debit and credit impact on different account types. So first we will be starting with why this debit and credit is required. To a company's financial data well organized, accountant used a system that divided transactions into specific records, which is known as accounts. Whenever company is setting up accounting system, the accounts that are most likely to be impacted by the company's transaction are identified and listed. This compilation is known as company chart of accounts. Now, the company chart of accounts, it will depend on the company's size, their complexity of its business activities, and the chart of accounts can range from a concise list of around 20 accounts to an extensive list of hundreds of accounts. They can maintain it. And the companies have the flexibility to customize their chart of accounts to suit their specific needs and operational requirement. So as per their requirement, they can go for number of charts of accounts a company can maintain it. So now coming to the debit and credit. Now debit and credit are the fundamental building blocks of the double entry accounting systems. You have heard about this double entry, single entry accounting system. So debits and credits are the fundamental building blocks. If you are not able to understand the debits and credits, you will not able pass any transactions in the double entry accounting systems. So what is the debit and credit? Debit and credit represent the flow of value into and out of a company's general ledger accounts. So how much money is coming or how much money is going out, we will be passed this transaction in the ledger account and it will represent the debits and credits. Every transaction which requires at least one debit and one credit entry, and those amount must be equal in nature. So if I am passing it 20,000 money is coming in the business, so 20,000 we have to pass it that somewhere it is going out from the business. So the amount should be equal in nature. Whenever debits and credits balance each other out, the company's books are considered in balance. So why we are making it the transaction both way, in and out? Because we have to consider the company's books as in balance. So how much money is coming in the business, that much money is going out the business. So this balance is very much required for generating accurate financial statement, which includes maybe income statement, maybe balance sheet or any other key financial reports. This system, which is used globally ensures that each financial transactions affects at least two accounts in a way which can maintain the accounting equation. The equation is assets is equal to liability plus equity. This accounting equation has to be maintained by the way of flowing in and flowing out the value of money in transactions. So this will be understanding the roles and impacts of debit and credit is crucial or very important for accurate financial record keeping and reporting. This introduction serves as the foundation for more complex accounting concepts and practices. So every journal entry is recorded as either a debit or a credit, and the classification of an entry as a debit or a credit depends on the nature of the transaction and the type of account involved. So it's very important whenever we are passing any journal entry, you should understand what will be on the what is the type of nature of the transaction and what are the type of accounts involved in that particular transaction. So now coming to the what is debit. So a debit indicates an amount owed or spent representing money flowing out. So whenever the money flowing out from the business, from the company, that will be debit. And a credit signifies, which is the money opposite to the debit side. Credit signifies, indicates money received or interested, represented money flowing in the business. So debit will be amount owed or spent, representing money flowing out from the company, while credit money received or representing money flowing in the business. So debit is represented as or abbreviated as DR, and credit represented as or abbreviated as CR. Now we understood debit and credit. Now I will move to impact of debit and credit on different account types. How it will impact when we are making any transactions, how it will impact different account types. So understanding the impact of debit and credit on different account types is very important in accounting, as it forms the foundation of recording financial transactions accurately. In organizations, ledger consist of different types of accounts. Maybe it may be asset account, maybe expense account, maybe liability account, revenue account, or gain and loss account. So there are different types of accounts which will be involved whenever any general ledger transactions we are making it. Now how these different accounts will impact debit and credit, I will be showing each of the account with debit and credit. So first one is asset account. So what is an asset? An asset account represent the value of resources owned by a company. So how much money, how much resources a company is having, that will be included in their asset account. And why it is important to maintain the asset? Because it anticipates to yield future economic benefits for the company. For example, it may include cash account, accounts receivable, which will be the money will be entered in the asset account, certain inventory the company is having, or any property, equipment, all those will include in the asset accounts. Now how this debit and credit will impact the asset account? Whenever there is a increase in asset account, it will be debited. So for example, purchasing equipment, a company has planning to purchase an equipment for cash. So what will be the transaction entry? What will be the journal entry? Debit equipment account and credit cash accounts. So debit, there will be increase in, whenever there is a increase in asset account, there will be debit. Whenever there is a decrease in asset account, it will be credit. So here, for example, whenever we are selling any inventory for cash, so debit will be the cash account and credit will be the inventory account. So in asset account, you should remember debit increases an asset account and credit decreases an asset account. Now we will move to the next account, that is the expense account. So what is an expense? An expense account represent or incurred by company in its operations and its revenue generation. So which will include, expense account will include the most expense will be for the company's cost of goods sold, or the company is providing any services, or company is providing salaries to their employees, their travel expenses, or any advertising expenses. If the company has any has to pay any rent, this all will be included in the expense account. How it will impact? Debit increases in expense account and credit decreases in expense account. So now I will be giving certain examples based on how this debit increases in expense account. For example, paying utility bill, or the company has paid electricity bills. So how it will be, journal entry will be passed. Debit utilizes expense account. There are two accounts involved, utilizes expense account and cash accounts. So debit will be utilizes expense account and credit will be the cash account. And I told you credit decreases in expense accounts. So for example, reversing on overstatement of office supplies expenses. So there are two accounts will be there, office supplies and utilities expenses. So debit will be office supplies account and credit will go to utilities expense account. The next type of account is liability account. What is liability? Which the obligation of the company, which company has to pay certain amount in future. So a liability account represent the obligations which is owed by a company, which can be, for example, credit card balances, they have the accounts payable, certain notes payable, company has to pay certain taxes or loans, that will be included in the liability account. Debit decreases a liability account and credit increases a liability account. So always these two formulas you have to remember. What will be increase and decrease will impact in liability account. So debit decrease a liability account and credit increases a liability account. So for example, company have paid certain loan, paying off a loan. So it will be two accounts will be there, loan payable and cash account. So debit will go to the loan payable account and credit will go to the cash account. And if credit increases a liability account, for example, company has received a loan from any bank. So there will be two accounts, cash account and loan payable account, debit cash account and credit loan payable account. Next is the equity account. So equity account represents the shareholders' stake in company's assets. For example, stocks, distribution, the contributed capital or any dividends and retained earning will account to the equity account. Dividend is the profit which will be divided, the percentage of profit which will be divided among the shareholders, that is dividend, and the remaining amount which the company is keeping with themselves is retained earning. How it will impact debit and credit? Debit decreases an equity account and credit increases an equity account. So for example, distributing dividend, company has decided to pay certain dividend to their shareholders. So debit will go to the dividend account and credit will go to the cash account. Or the next, it will maybe the company is start issuing the stock or shares to their shareholders. So then it will be the entry will be debit the cash account and credit the common stock account. The same way we can, another type of account is revenue account. So revenue is, it reflects the amount of money generated from operating and non-operating activities. So here there are two types of activities through which company gets certain amount of money which will be generated by a company. So when you talks about the operating activities or operating income, it includes sales, consulting services, the core business of the activities that will comes under the operating activities. Non-operating examples or activities includes interest and investment income. So company is having certain amount of money, they have made investment and now they are getting generating income from the investment. This is includes the non-operating activities. So debit decreases a revenue account and credit increases a revenue account. So for example, refunding revenue due to customer returns. Customer has returned some of the goods and the company has to pay certain amount of cash. So now this will go to debits, sales return and allowances account, and the credit will go to the accounts receivable account. Other example is earning service revenue on credit. Company has earned certain services revenue on credit. So it will go, the entry will be debit account receivable account and credit will go to the service revenue account. The another type is gain account, gain and loss account. So first I will discuss about the gain account. So what is gain? Reflects an increase in value from the activities which is not related to the core business, or you can say that non-operating business activities. Whenever there will be income from the non-operating business activities, it will be incurred into the gain account. So examples may be money won from a lawsuit. Company has filed a case and then he is getting some amount of money from that case. So it will be gain in value from the sale of an assets or any business property. It will be coming under the gain account. So debit decreases a gain account and credit increases a gain account. So for example, reversing a previous gain from the sale of an assets. Here debit will go to the gain on sale of asset account and credit will go accumulated depreciation account. Another example, whenever recognizing a gain from a lawsuit settlement. Company is getting some gain from the lawsuit settlement, so it will go to the debit cash account and credit will go to the gain from lawsuit settlement account. Next is, it is similar to the loss account. It will be the opposite of the gain account, which reflect the decrease in value from non-primary business events or the non-operating business activities, which include money paid for the loss of a lawsuit or loss in value from the sale of an assets or any business properties. So which will include debit decreases a loss account and credit increases a loss account. For example, recording a loss from the sale of an assets. Company has sold some of their equipments where they have incurred certain amount of loss, so it will go to the debit loss on sale of asset accounts, and it will go to the credit accumulated because of depreciation, so credit will go to the accumulated depreciation account. And another example may be reversing a previous loss related to a lawsuit settlement. So debit will go to the loss from lawsuit settlement account and credit cash accounts. So this will be the loss accounts. And by concluding this concept, you can remember how this debit and credit involved, or increase and decrease, how will impact different account types. You can remember the deal and girls. Deal, D-E-A-L. D-E-A-L, D represents here dividends or any draws. E represent expenses, A represent assets, and L represent any losses incurred by the company. So these, if any accounts will come, always there is increase with the debit side. So if any of these accounts that are increasing, that will be represented with a debit amount. So deal accounts that are increased with a debit. These are the dividend, expense, assets and losses. Now the next is another is girls account. Girls accounts which are increased with a credit. So in girls, G is represent gains, I represent income, and R represent revenue, L liabilities, and S represent here stockholders or owner's equity. So these are the different accounting transactions through which you can understand how there will be increase in the debit, and how it will be, these are the accounts which are the increased with a credit accounts. I hope you could have understood the concept of debit and credit and how it will impact different account types. So thank you.